Welcome back to RoxomTV and also welcome back to GemGem Crypto. So today I'm again doing my live at home because I kind of want to take a little break. And going to the studio from my house is a very long journey. So that's why I'm doing it in my house. Well, anyway, so what we're going to do today is that we're going to dive into Bitcoin. Because Bitcoin looks like it's doing exactly as we predicted using TA, so using math basically. Well, looks like, a few days ago, I talked about the relief rally. We actually went up to 93K and then we got rejected. Right now is hovering around 86K. I actually talk about the hedging method, so I hope you guys catch my previous shows because so far the hedging position has been working pretty well. So math has been working pretty well in my favor. So I'm not talking about being a ultra bear, a perma bear here. I'm not long-term bearish on Bitcoin. What I'm doing is that basically managing my risk. If we only have long position, because think about it, if you didn't sell your spot position, if you have stocks and if you have, I don't know, your pension fund and 401k, what you're essentially doing is that you are exposed to a huge amount of risk because your entire portfolio is actually betting the market to go up only. So hedging is actually making a lot of sense, and especially for me. And what I've done for the past month basically is that I have been hedging some of the altcoins. For some reason, I don't know why, some of the altcoins that are really overvalued, yet they are still listed on centralized exchanges. And it's kind of like easy money, I would say. So we know altcoins, alt season, we technically didn't see an alt season this cycle for whatever reason. For people out there saying the narrative, this cycle is different because, institutions are in, we're not going to get that volatility. Well, it seems like they are right on certain stuff. They are right because this cycle is different. Retails weren't here. That's why we didn't see the alt season that we were promised for. But again, the volatility is very much still here. Well, anyways, since this is the weekly close. Today is Monday. I hope you guys are having a fantastic day. So since this is a weekly close and today is Monday, let's actually dive into charts first and do a little bit of TA. We are on the daily chart. Of course, we are starting from the shorter time frame, and then we're going to look at the weekly chart in just a bit. But here on the daily chart, we are still on a general downtrend. I drew this ever since we have been forming a tiny from 126K till 122K, because on the hourly chart it shows that it is showing a very, very clear downward movement, a downward momentum. That's why it was printed on the daily chart as well. So anyways, so far it's just a dead cat bounce. I've talked about a dead cat bounce for days actually, and then I don't have much conviction for people to call this, okay, this is just a hiccups because the smart money are here, so that's why Bitcoin's not going to go any further down. But even at 93K, I was talking to my community that this looks like a relief rally and seems like that's exactly what we got. So if you guys didn't de-risk when we dropped to as low as 80K, here it was a really good opportunity for you to do that. The reason why I managed to call the bear market early, and this is a bold statement because if you hop on to YouTube, if you hop on to Twitter, a lot of people still saying that this is just a hiccup. We are heading for the best is still ahead of us. 2026 is going to be one of the best year for crypto, especially if you look at things through a macro lens, through a macro perspectives, because most of the macro analysts out there, they are still saying, okay, the 4-year cycle is BS. We know that the BlackRock is here, so there's no way we're going to get such a volatility. Well, I hate to break it to you, like, even though in 2025 and even though with BlackRock money, there is still such a volatility, like a 36% correction in a matter of 2 months, so less than 2 months, we get this correction. So again, like, the charts don't lie to us, the number don't lie to us. I know the narratives, it sounds very promising, but until it's actually being reflected on my chart, I'm sticking to what has been working from the past record, from the track record that I have. And looks like in this cycle, TA and the 4-year cycle works the best, while macro and on-chain analysis is still, maybe they're looking at very long-term perspective. That's why it's not, so far, it's not working out in my favor, while TA is working the best. Anyways, like, speaking of the daily chart, we have to look at the death cross because today is Monday and we have the weekly close. So we're going to spend some time looking at the daily chart a little bit. So here, I want to talk about death cross. What death cross means is that there are 2 lines here. So we have the red line and the blue line. The red line basically it stands for the 200-day moving average, while the blue line is a 50-day moving average. So if the longer time frame, so if the 200-day goes above the 50-day moving average, that is a death cross. And in this cycle, we tested the death cross quite a few times. So here we tested, we have tested death cross, and then this happened in April as well, and this happened again in August, and here again, that was in September 2023. But one thing this makes it different is that if we actually zoom closer and if we compare the difference between these like data points, usually the death cross, when that happens, that means the bottom, the local bottom is near. And here, like, we have the death cross, and then just like a few days later, we got the bottom. But here, okay, this is one of the difference. And another difference is that usually when we have death cross, it's very quickly for Bitcoin to bounce back and trying to basically touch the 50-day moving average. That's what we got in September 2023. So it almost like a cloud, because like in between the blue line and the red line, there's a gap, right? So I like to call that a cloud, where it's not a cloud, but like, you get what I mean. So very soon after we have the death cross, Bitcoin would try to get close to the 50-day and then actually trade inside this cloud, so inside this gap. That's what we have seen back in September 2023. That's what we have seen in August 2024 as well, and exactly the same in April 2025. However, looking at the current setup right now, right at this instance, looks like there's still a lot of room for Bitcoin to pump. So right now it's 86K and the 50-day is sitting at 101K. So we have to pump another 18% just to reach the blue line. Not to mention, like, usually for a dead cat bounce, we'll rally even up to the 200-day, but we didn't even get that. So that's how bearish the whole chart, the whole setup looks like to me. And I really, like, from a knowing math and understanding TA, I cannot convince myself to be on par with macro analysts. Like, I know it sounds like there are so much tailwinds for to come in the coming weeks, or even in the coming months, but like, so far the whole setup it doesn't show me any strength. While Bitcoin can't even go back and touch the 50-day moving average, can't even go back to touch the to go into the gap, basically the cloud that we're forming. Because last time, if we zoom out to 2021, when we start to experience the bear market, so of course the death cross form here and then we form here again, but like there are the theses we have to look at. So here for the death cross, so that's basically how we confirm the bear market has officially started. Like even here for 2020, late 2021 till 2022, so early 2022, Bitcoin have the death cross. So that was on 12th or actually 15th of January 2022. And then we even try to touch the blue line. So we spent like 24 days and trying to catch up 24 to 25 days to try to get to the blue line. But here, like, okay, we have the death cross. So this cycle. And after 15 days, okay, 15 days is maybe not a lot, but like in the coming week, let's see if we manage to even, I'm not even talking about the 200-day moving average here, maybe the 50-day moving average here. Like, so far, I'm not seeing any strength for Bitcoin. And that's why from a TA perspective, it's really, really bearish. For me to basically be vibing with the macro analysts out there, on the charts, I need to see that, first of all, I have talked about the downtrend for basically since October. So here we are forming this downtrend from 126K. We need to have a weekly candle actually close above that for me to turn bullish again, not just like wicking, but actually close above that. And another thing is that 108K. So here, this is a key level I'm watching because like the red line, since we dumped so much, I won't be surprised that we're going to slowly go down a little bit more and reaching 108K. And 108K, this is actually a magical number. I've talked about that quite a few times as well, because 108K, if we zoom out, it also happened to be the previous all-time high. We found resistance here and then support here. So prior support here, we have been building around 108K. It's going to be our future resistance. So technically speaking, any value anywhere below 108K, this is a bear market. So that's why I'm not like switching into a full-on boo mentality right now. So, and I don't really have much respect for influencers out there. And basically, I am seeing so much bull posts on Twitter and everyone just like, oh, buy the dip, buy the dip. Like if you just keep buying the dip, because like so far it looks like it's following the exact same pattern as the 2021 or most of the bear markets of Bitcoin. Like looks like it's just like following the 4-year cycle. So if we just end up buying the dip, you're eventually going to run out of money if you keep buying, because it's normal for a bull market to have like chops or consolidation. Like overall, it's still going up. So here it will be a tiny pullback in a bull market. And the same thing applies to a bear market. Like we're going to have a bull trap. We're going to have a relief rally, and some people would be like, especially on Twitter, saying, okay, we're so back, like I hope you bought the dip, but only to find out that the bear market just carries on. So this is for the daily candle what I've seen. Let's actually hop onto the weekly candle. So weekly, I want to spend more time looking at the RSI today, because like one thing about the RSI is that we broke the major support that we have been forming for months actually. So this cycle, the magical number is around like 44 on the RSI, and we broke that support. Usually when we do that, so usually when that happens, that means that Bitcoin is basically it's still going to have some correction to come. So we still have to wait around. So this cycle is 41. This cycle is 44. Last cycle back in starting from 2020 to 2022, the RSI is about like 41. So usually when we broke the support, like especially the support has been building for like 2 years, and if we broke that, that means we're going to have more correction. So here, so more correction to come, and that's exactly what happened. The same pattern that has been following out has been playing out for years, and yeah, that's another weakness I'm spotting from the RSI. And not to mention, speaking of the RSI, there happened to be a RSI bearish divergence. And if we look at the previous cycle, that being 2020 till late 2021 or 2022 bear market, like when we have this bearish divergence, like what it means is that RSI is taking a downward slope, is telling a bearish sign. However, the price is going to a higher place. Same for here, like the RSI for this cycle, we have been flashing for basically since 2024. So more than a year, like a year and a half. So we are seeing this divergence while RSI has been warning us, especially from a weekly perspective, so a longer time frame perspective. RSI has been warning us that, well, something is wrong. Looks like we're getting a little bit frothy. This is what the RSI does. And yeah, the same pattern plays out again. If we combine that, so we lost the support on the RSI at 44. Right now, we're sitting at 37. So first, we lost the support, the major support, since January 2023. And then second of all, we have been building up this bearish divergence since March 2024. And it looks like we finally play out this pattern rather well. And this is just the weekly I want to look at. But since we have a green candle close over the weekend, because like we closed out on Sunday, we have a new candle today. Today is Monday, and so far, and not only the weekly close, we have the monthly close as well, because November we have a negative return, 17%. I'm sure a lot of people wouldn't have expected that, because people like to call it Moonvember, or even October. People like to say it's Uptober. But these 2 months and have been generating quite a lot of disappointment. Let's just put it that way. So yeah, let's see if December we manage to close with a green, like maybe a 0 point something percent. But I'm not like particularly positive here. But just looking at the monthly returns, since that we've dropped so much already, maybe December it doesn't have to gonna be like so much downward movement. But let's see how that plays out. And another thing I want to talk about is the Ichimoku cloud. Like I haven't really used this on this channel, but this is actually a leading indicator that is great for telling where we are heading to. And I found that Ichimoku cloud works the best on the weekly time frame, so on the higher time frame. And basically, how do you read this? It's so confusing, Jeremy. Well, all right, so there are some gaps. So we have the green line on top, and then we have the red line. Usually how you read this is that, okay, we have the Bitcoin price here, and if the price managed to stay above the cloud here. So the cloud is right here. And if the Bitcoin price is actually above that, that means we're in a bullish momentum. Same thing applies for a bear market. So if the price actually trading below the cloud, so you see the cloud is actually sitting here, while the Bitcoin price is right here. So that is a bearish momentum. And the Ichimoku cloud is a leading indicator, which makes it so great. Well, one thing that the Ichimoku cloud call it perfectly well is that if we take a look at the previous bear cycle, the previous bear market, if we zoom closer, the Ichimoku cloud has been warning us that, okay, at 69K, that was the people were so euphoric saying we're going to head to 100K for sure. And then we have a few weekly close, and then it almost like there are patterns that we have to follow. The formula is we have to look at the 50-week moving average. So being the blue line here, so if we have a weekly close, technically we need 2 weekly candles close below the 50-week. So if we zoom closer to the previous cycle, we first close below the 50-week here, because like touching, it doesn't count. So here, it's just like touching, so it's a week. But here we actually closed below the 50-week. And then we are reaching the Ichimoku cloud. We reached the top of the Ichimoku cloud, which is, again, quite concerning. And then once we get below, and maybe trade inside, so we actually consolidate a little bit before actually went down and touched the 200-week moving average. So this is the recipe for a bear market. Like people will say, okay, Jamie, like if we look at the 50-week moving average, like here it was quite concerning as well. So back in June 2021, like we have a weekly candle. So the weekly candle actually closed below the 50-week. That was back in July 2021. And then people were so concerned. Yes, but if we bring out the Ichimoku cloud, like the Ichimoku cloud, even for the upper band, we were sitting at 27.9K. So point being, the Bitcoin chart actually didn't go below or even touch the Ichimoku cloud at all. So that is the formula to clarify whether it's a bear market or it's just like a bear trap. So here in November 2021, we not only we closed below the 50-week, we touched the upper band of the Ichimoku cloud, and then we get inside to the cloud. So basically this consolidation period. So if we apply the same thing to this cycle, so here almost the same thing is playing out. And here it looks more bearish compared to 2021. The reason why I would say this is that this cycle, we have 2 weekly close below the 50-week moving average. And we are inside the Ichimoku cloud. So yeah, it is a bear market, and the bear market has progressed even sooner than I expected. I'll admit that. And that's why I really don't understand why all these analysts out there are saying we're still in a bull market and things are going to get better in 2026, because that's not what I could see from the chart. Yeah, I mean, you guys come here for the truth. And I know this is not a popular opinion, and I've been calling that for a long time, for a few weeks. And yeah, I mean, well, looks like for the coming weeks, since that we are looking at the weekly chart, we might get some more dead cat bounce, or even trying to reach the top of the Ichimoku cloud. But since that we officially enter the cloud, so enter the gap, well, looks like it's just going to be a slow ground to maybe the 200-week moving average. But like, okay, 200-week right now is sitting at 56K. It looks like a very low number, but like bear in mind, this is slowly going to catch up, and by the time we are done, maybe like the cycle bottom would be around 59k or something like that. The reason why we like to use the 200-week moving average as a metric, as a reference to look at, is because usually when Bitcoin bottom, so when a cycle bottom happens, it will be somewhere around the 200-week moving average. However, 2022, it was a special case because there was just like too much FUD, like FTX and yada, yada, yada. That's why we went below. But usually we just like, we found support at a 200-week moving average for a bear market, and then slowly gonna consolidate a little bit and then slowly grind up. All right, so that's what I see on the TA. What we're gonna do right now is actually take a little break, because like after that, we're gonna look and dive into the global economy. Like some countries are doing better than the others, but general trend, I'm seeing a slower growth in the global economy. So I'm going to dive into the data in a bit, but like let's take a little break and I'll see you guys in about 3 minutes.
Security matters. Zappo Bank, the only way to bank your Bitcoin. Apply now at zappobank.com.
Some call me Chicken Little, others Bubble Boy. I'm a bit changed, but sounds familiar, right? Let me tell you a hard truth. The S&P isn't rising, the dollar's falling. That's the trick. Monopoly money. It's ice melting by the second. Your savings, your salary, your time. Worth less every second. Everyone's using the wrong measuring stick. Switch the denominator. Price the S&P into Bitcoin. Hard, fixed, unprintable. Suddenly your unstoppable index is collapsing. And while you cling to dollars, well, Wall Street already switched. Before, you needed 2 brokers.
Still getting my ninja bonus though, right?
Plenty of spreadsheets. And my quant!
I hate this part.
I was right, and I'll be right again. If I were you, I'd thank me.
You know my name's Dave, right?
All right, guys, welcome back. As I promised, we're gonna spend some time and really do something different and look at the global economy once and for all, because it looks like it's slowing down. Does it mean the world is heading for recession? No, that's not what I mean. But like, there are signs that looks like maybe the world economy is not doing as well as we thought. So today, we're going to dive deeper into each country. Well, not each country, but the major country. So think of the world economy like a huge ship in choppy water. It's not sinking, but it's rocking with every new wave. So trade tensions or manufacturing slowdown, some political drama and war. So my goal is to help you understand where this global ship is heading and what it might mean for our jobs, our investment, and our day-to-day lives. So let's zoom out and look at what's going on in the whole world. So global growth in 2025 is expected to be around 2 to 3%. That's like the world economy jogging but not sprinting. Outside of recession, this is one of the weaker growth periods we have seen actually. So the question is, why the slowdown? So first of all, there's trade tensions, particularly between the big economies like US, like China. They are fighting over trade and technology. I know it looks like the tariffs kind of be settled for a while, but looks like it's not like a long-term solution. And then again, like this cycle, it makes the global economy so different is because the policy, there's like uncertainty in different areas like geopolitics, and the global trade is really limping. World trade is still growing, but like at a slower pace, roughly 2 to 3%. We're not collapsing entirely, but definitely not strong. And when it comes to globalization, is rewiring, not dying. Instead of one big US census system, we are seeing more regional blocks. So Asia trading more with Asia, emerging markets trading more with each other, countries trying to reduce dependence on a single partner. So there is a lot of structural headwinds that I saw. And this happened especially to advanced economies. So in other words, like US and Europe. So all these places, they are facing aging populations, and not only advanced economies have this sort of problem, like even for emerging markets, like the whole world, we are experiencing some global shocks like floods, extreme weather, and it's only going to get more common because like the world is very polluted, and extreme weather is only going to rise in the future. So the bottom line, okay, there's a lot of structural headwinds I saw. We are not in a global crisis, but the situation is more fragile than ever. It wouldn't take a huge shock like a big war or a big financial scare to push growth even lower. And this is the, like, if we zoom out and if we look at the entire world, the general world economy. But now let's actually zoom closer to each of these major countries. So let's actually look at the US first, because the US is still the engine of the global economy. And in late 2025, looks like the US is doing better than most. So quarter two 2025, we got a 3.8% annualized GDP growth. So that's actually really good. A strong, actually a lot stronger compared to a lot of countries out there. And if we look at the unemployment rate, yes, it's taking up right now, is sitting at 4.4%. However, like if we actually zoom out like 5 years, it's actually not that bad. And compared to many other countries, like 4.4% is still all right. And for US, there's a tech boom. Like a huge chunk of growth is driven by AI and tech and investment. So think of AI as the MVP of the US economy right now. Actually, the whole US economy is betting for the AI narrative to work. Otherwise, US is going to be in deep distress. And if US is going down, the entire world would go down. So yeah, there is some bubble for the world economy, but is it going to pop anytime soon? Like I don't think so. Like there are signs, that's all. So what's going wrong? Like inflation wise, the US has like lower inflation since the 2022 peak, but it's not fully tamed. People still feel prices are really high, especially for rent or for food, for services. And for the government shutdown in the US, so it lasted for like the longest shutdown ever. What happened during the shutdown is that the federal workers weren't paid, and national parks were closed, and in important data like the jobs market, inflation reports, they were all delayed because no one was working and they couldn't collect the data. It didn't crash the economy, but it hurt confidence and reminded everyone how messy US politics can be. So like we are just getting out of the shutdown, and what happened during the shutdown was a TGA account when a record high, it broke like $1 trillion. What it means is that basically the US government has been collecting so much money without spending it because like the tax money keeps coming in, but there's no place for the US government to spend it. This is actually a very deflationary setup, and this is actually hurting the US economy quite a lot just because of the shutdown. Like people would think, okay, if the US government is not spending that money, that means they're getting richer, right? But it's the opposite. Like if the money is not injecting to the economy, like citizens can't use that money, and basically the citizens would feel more poor, and they would hurt being their confidence would be hurt. And this has a deep tie with the interest rate in the US as well. So the Fed raised interest rate aggressively in 2022 to fight inflation, but by late 2025, it finally started cutting, but very, very cautiously. Like even now, we could not be 100% confirmed that we're going to get a 25 basis point cut, but according to Polymarket, it looks like that is the case. So interest rate, that means like borrowing costs for everything, like for mortgages, for business loans or credit, like it may stay relatively high a bit longer, because like right now the interest rate is still sitting at like close to 4%. So there are also a lot of tension going on compared to basically is as a, I wouldn't say very fragile, but like if we zoom closer to look at each country, looks like we all have weakness after all. So between the US and China tech trade war, the US has restricted China's access to advanced chips and tech. China, of course, hit back by restricting exports of critical minerals used in batteries and electronics, the rare earths, of course. And earlier in 2025, it looked like things were spiraling. Then in late October 2025, they agreed with like a 1-year mini truce, meaning China would resume some rare earth exports and buy some US goods. The US, in other words, on the other hand, would pause some planned tariffs and ease pressure on certain subsidiaries. Is a pause, not a peace. So the rivalry is very much still there. And if we look at the manufacturing PMI, looks like the PMI, okay, we still sitting above 50, which is a very modest expansion. And services on the other hand is stronger, so like mid 50s, so it's quite a solid growth. But companies are reporting slower new buys and inventory build ups, and a lot of products basically sitting in warehouse. The reason why they would do this is because they are scared of tariffs. So if that continues, production could slow in coming months. And as for the dollar, as for the DXY, the dollar is looking stronger. Like the US is holding up surprisingly well. We are still sitting at $99. Let's see if we're gonna break that $100, because like we tried to test that just last week. And point being, the US is holding surprisingly well, strong growth, relatively strong labor market, like a 4.4% unemployment rate is not it's not a nightmare yet. And US is still very focused on the whole AI and tech investment. But of course, inflation is still a concern. We're still in a high rate environment. Ongoing tension with China is a strong ship in a narrow and very rocky channel, capable but not very convincing. All right, so this is just the US. And how about we hop to Europe and look at the big brother in Europe. So Europe is doing a lot worse compared to the US. Many European countries are near zero growth. Some are kind of in a mild recession. And when we look at Europe, the first country we need to look at is actually Germany, because like Germany is the industrial heart of Europe. So when you think cars or chemicals or machinery, like you from Europe, the first country you think of is Germany. And as for Germany, so far the growth, the production, industrial output is at a 20-year lows. Why this happened is because there are weaker and lower global demand, especially for cars, for machinery. There's a higher cost after cutting off Russian gas. It's a very painful transition from traditional cars to EVs. So in other words, Germany's old model, so export high quality stuff to the world, is under some very serious strain. And if we look at other European countries like France, France is not doing well at all. Let's just put it that way, because I want to be a nice person. So France, they have some political reset, some protest, and budget deficit is really high. Government has less room to act aggressively, whereas in Italy or in Spain, they have high debt. They rely on the Central Bank of Europe, the support and the EU funds immensely. And if we look at the UK, UK is not in the EU, but outside the EU, but it's still a huge part of that region. So UK is experiencing weak growth, a really weak growth, and UK is still dealing with the Brexit fallout. So it's a very controversial topic. Like, people say Brexit actually damaged the UK, but that's another story. And markets worry about fiscal credibility, like the pound has weakened quite a lot against the dollar. So Europe is not doing well. And there's still, bear in mind, there's still war ongoing. War continues, though, because it has been ongoing for a few years. That's why we get less headlines. But Europe pays the price via higher energy costs, defense spending, and supporting Ukraine and refugees. And Russia also used like hybrid warfare, like cyber attacks, energy pressure, keeping Europe on edge. And Europe gets squeezed by both, so US subsidies and rules that hurt EU exports, like US EV incentives, whereas China, like the Chinese restrictions on key minerals and components. So Europe often feels like collateral damage in a game played by Washington and Beijing. And for the currencies, like euro is very stable, but like it's not strong, like trading in moderate range. And for the central bank of Europe, they have cut rates a bit to support growth, but inflation is still about 2%. So they are being cautious, just like US as well. And as for the British pounds, as I mentioned, it has been doing not good at all against the US dollars. So looks like Europe in a lot of these places is basically treading water, weak growth, expensive energy. There's a war right next to the door, and political constraints. So Europe, like out of all the countries we are looking at, looks like it's in the most distress. It's not collapsing, but it's very vulnerable to shocks. And let's also zoom out to another country. Of course, like one of the major player we could not ignore is China. So China is the world's second largest economy. But if we look at the GDP growth in China, China used to grow at about like 8% to 10%. However, those days are over. Like right now, the growth is like closer to 5%, which is okay, but not spectacular. But Okay, seeing a huge jump like this, so from 6%, and then obviously like 2020, we have the COVID, and then once the COVID situation has been under control, we went back to 8.6%. But like seeing a huge shape like this, I wonder what's happening China. Okay, turns out for the Chinese economy, one of the biggest concern is the property sector. So big developers are in big trouble, and the housing demand has been weaker than ever before. Because for Chinese people, we educated as a mindset that if we have spare money, it's always good to buy houses, so buy properties. We call it buy bricks because houses are built by bricks. So we also say buy bricks. But what happened is that kind of the kind of the housing bubble has been popped in China, and consumers, so citizens, don't want to go out and spend money. So Chinese citizens actually have a lot of money, but because the sentiment is not good, people are very bearish. Like they much rather hold, I don't know, hold a pile of cash maybe underneath the mattress. So that's for one reason. And then second reason is that the trade tension. So US exports control on high-end chips and technology. What's supporting China is policy stimulus, so rate cuts, more fiscal support, infrastructure, strategic investments. And China is also exploring new markets to Asia, to Middle East, to Africa or Latin America as Western demand kind of slows anyway. And for the from a China's angle to look at the US and China truce, like China agreed to resume some critical exports to buy US commodities, but at the same time, China is building its own chip ecosystem, securing alternative suppliers for food, for energy, and raw materials, and deepening ties with via the Belt and Road region. So, as I mentioned, some part of Middle East, Africa, Latin America, and there's still a lot of challenge in the Chinese market. For example, property sector still very much in a fragile spot. And when it comes to unemployment rate, like China is actually a lot higher compared to US, and especially for youth. So when a kid just graduated from uni, usually it's very difficult for them to get a job. So that's why youth unemployment is so high in China. And consumers are really cautious. They don't like to spend, even though they might actually have a lot of money, a lot of cash sitting inside their house or something like that. So that's the Chinese mentality. And for China, China is stabilizing but not booming. The government is actively prepping, so it's propping up the economy and trying to pivot to a more self-reliant, consumer-driven model. And yeah, that's just for China. We actually so far cover US, Europe, so Germany and UK and China. But now overall the developing world, the emerging markets and low income countries, this is a mixed picture. Like overall, they're limping forward. There are a lot of like headwinds that I saw, like slow global trade, less demand for exports, high debt, inflation is like still relatively high. But if we look at the bright side, there are countries that are doing really well. For example, India. India growing around like 6%. There is there's a huge young population in India, big domestic market, and new factories, new jobs, strong consumer spending. So India is a market that I found really interesting in terms of the whole global economy I'm seeing here. And other part is actually the Middle East. So they benefit from higher oil prices, more physical space short term, but like long term fossil view, of course, like it remains quite risky because we know we're going to pivot to green energy. Looks like that's going to be the trend. So, yeah, I mean, so far, if we look at the global economy, all this geopolitic risks, like there's still a lot of wild cards, like the risk that could make everything better or worse. Like these aren't forecasts; they are things to keep an eye on. For example, US and China, the current truce, it could fail. Like there is still a chance that would fail. If we get more tariffs or tech bans, that means weaker trade and more supply chain chaos. And in terms of the war, like Ukraine, very much there's an ongoing law, and that would very much affect Europe's security and energy. And if there's an escalation, let's see how the talk works out between Ukraine and Donald Trump and Russia. But if there's an escalation, there's more risk to higher energy prices, of course. And Middle East, like of course they have conflicts, and any disruption in oil flows through key choke points could spike prices. Basically, the headwinds, it looks like it has been building up. The whole world economy has never been this like volatile, I would say. Like even in the I'm saying current history, like the recent history. I'm not saying the long time ago, but like the world economy looks like is okay. Overall, the risks are titled to the downside. More ways for things to go wrong than right. That's what I see. And the key takeaway here is that there are key things to remember from this global tool. Global growth is slow, but it's not collapsing again. We are growing, just not fast, and the situation is fragile. The US is still the standout performer out of the entire world. The growth, we look at the GDP, is stronger than most. It's driven by AI and tech, but still wrestling with inflation and high rates and political drama. Europe, like I hate to use that word, like looks like Europe is done. And Germany's industry is struggling, energy is expensive, and the war in Ukraine still hides on the region. China is stabilizing with heavy government support. So like out of like all these regions, looks like US is still the big brother here, while their emerging markets doing really well, like India. So right now, the global economy is in a transition phase, like from easy money to higher rates, from hyper globalization to more fragmented trade, from old energy to new, and from old tech to AI driven systems. Like it's messy, but it's not hopeless. There's still innovation, still growth, still opportunity, just with more volatility attached. All right, so that's with the global economy I want to cover. I want to talk about this since a long time ago, but since like the crypto market is not doing much, and finally I get the chance to cover the global economy, because like as a Bitcoin investor, we always need to look at global economy. We always need to look at macro, where things are going, because it has a deep tie to Bitcoin now that we are multi-trillion dollar assets. All right, so let's take a little break, and after that, we're gonna dive into more crypto native news, because like a few days ago, we have a hack on Upbit, which is a Korean exchange, and then we're also going to talk about Monad, because that is a launch, and it looks like there is so much negativity on Twitter. Like people are so mad, even though Monad did an airdrop. So let's take a little break, and after that, we're gonna dive into the details.
Security matters. Zappo Bank. The only way to bank your Bitcoin. Apply now at zappobank.com.
Some call me Chicken Little, others Bubble Boy. I'm a bit changed, but sounds familiar, right? Let me tell you a hard truth. The S&P isn't rising, the dollar's falling. That's the trick. Monopoly money. It's ice melting by the second. Your savings, your salary, your time. Worth less every second. Everyone's using the wrong measuring stick. Switch the denominator. Price the S&P into Bitcoin. Hard, fixed, unprintable. Suddenly your unstoppable index, it's collapsing. And while you cling to dollars, well, Wall Street already switched. Before, you needed 2 brokers.
Still getting my ninja bonus though, right?
Plenty of spreadsheets. And my quant!
I hate this part.
I was right, and I'll be right again. If I were you, I'd thank me.
You know my name's Dave, right?
All right, guys, welcome back. As I mentioned, we're now going to take a look at Upbit because, like, just a few days ago, there was a horrible hack, $30 million hacked by Lazarus Group. Like, of course, Lazarus is one of the most dangerous hacking groups in the whole world. Is controlled by North Korean, and this time they hit Upbit. One of the biggest, actually the South Korean's biggest crypto exchange, stealing 30 million in a single attack that happened a few days ago. And the craziest part is that they actually hit Upbit on the same exact day they hacked it back in 2019. So today, let's actually break down what happened, how Lazarus pulled it off, and why Korea, and South Korea in particular, keeps getting targeted, and how this ties to the broader crypto landscape in Asia. So, of course, Lazarus Group, just to fill you in, they are the state sponsor North Korean hacking unit, widely linked to the North Korea's military intelligence agency. They are responsible for the Sony Pictures hack that happened a decade ago. They are also responsible for the Bangladesh bank heists and are over like multi-billion of dollars in stolen crypto since 2017. Those stolen funds actually help fund the North Korea's nuclear and missile programs, according to the US Treasury, that being. So they are very notorious for phishing sites, for social engineering, for blockchain laundering via mixers, via centralized exchanges and DeFi bridges. And this group and a lot of hacker groups from North Korea, they are highly trained, very professional, and they are very patient with the target as well. So let's come back to the news. So Upbit, how did this happen? So they targeted Upbit's hot wallet, where funds are kept online for user withdrawals. How the hack unfolded is that, okay, around midday, Upbit detected unusual outflows. Attackers drained over $30 million in Solana-based assets, so SOL, GMT, and a bunch of like dozen of other tokens. Funds were scattered across multiple wallets to hide the trade. And those stolen funds were quickly moved through 3 other exchanges. And Upbit, like first of all, they froze the deposit and withdrawals instantly. They worked with project teams to freeze certain tokens, and they actually reimbursed 100% of user funds from reserve. So that's good. This is actually the Upbit's second major hack in 6 years. and both were attributed to the Lazarus Group. So why we keep blaming this group? So the attack is awfully similar to the 2019 attack. They use the same malware families, same wallet classes, and same timing as well. South Korea also noted that the Lazarus Group has been extremely active in 2025. So that actually include the $1.5 billion stolen from Bybit. So they recover millions of dollars of that fund, but like they still walk away with like $300 million. So that's good for Kim Jong-un for more missile testing, I guess. So Upbit keeps getting targeted. Of course, like Upbit is the center of South Korea crypto exchange. They handle like 70% of that market share in South Korea. And South Korea and North Korea, of course, they're enemy. That's why like Upbit getting attacked by Lazarus, the group in North Korea, it shouldn't come across as a surprise. So Upbit is like, think of Upbit as the basically Coinbase plus Binance of South Korea combined. Yeah, so that's why it just like keep getting targeted. And usually for South Korea, they only use certain exchanges because like Korea's regulations are extremely strict. Like you need real name and verify bank accounts. You need to do KYC and AMLs. So what this created is that there's a duopoly, especially for Upbit and BitThumb. They control most of the market share. So here, Upbit control like 70% of that crypto trading inside South Korea, and then the second one is BitThumb. So they control like 15%. So they basically these two exchanges have the entire crypto share of South Korea. Foreign exchanges in South Korea, they're restricted. Many Koreans cannot freely move large amounts offshore due to capital controls. And this is also one of the reasons why we had kimchi premium. Like what it means is like when Bitcoin trades like 5 to even 20% higher in Korea because capital cannot be easily leave the country. That's why we had that kimchi premium. So the kimchi premium is getting smaller, but it is very much a real thing because like the first time I heard that term, I thought it was just like some meme, but like turns out it was a legit thing in South Korea. And Korea has one of the most intense crypto cultures, like when it comes to the kimchi power. Like a lot of the young people in South Korea, they trade crypto, and usually they have a strong preference for volatile altcoins, not just BTC. And they have the culture of aggressive trading and aggressive leverage. That's very interesting about South Korea. Like if they have $100, they're gonna back $110. That's one thing I noticed about South Korea, and maybe the DJ mentality where 100x gains outweigh risk management. But maybe okay, let's tie back to Lazarus. Maybe this is one of the reasons why Lazarus target South Korea as well, like especially through crypto. And what we know about Lazarus so far is that, of course, it equals to North Korea. The attribution is really strong because like there is shared malware code with WannaCry, IP server overlaps trace back to North Korea, and US DOJ charges against North Korean programmers. So while of course like North Korea denies all the involvement, the pattern, the code reuse, the beneficiaries, they all align constantly. So all fingers point to Lazarus Group, point to the North Korean. Okay, so far the Upbit hack is more than just another exchange exploit. It highlights a much bigger pattern. Like North Korea's top hacking group is escalating again. Well, they never stop, but like they just got better, and especially with AI being so prevalent these days, hackers can use AI to basically benefit the hacking program massively as well. And South Korea remains one of the most lucrative crypto markets in the whole world. There's a lot of money inside the South Korean market, and yeah, I mean, Upbit just really need to be very cautious when it comes to the risk management, because they kind of have a target on the back. Especially they control 70% of South Korean crypto market share. Yeah, even though Upbit freely reinvest users, the message is pretty clear. The Lazarus Group is not slowing down, and centralized exchanges are still prime hunting grounds. So yeah, this is the key takeaway for this news. Let's actually move on to the second news I want to talk about, so Monad. Monad, if you guys didn't follow, the most anticipated altcoin launch of the year, Monad, is already crashing. And this is a tier 1 project we're talking about, backed by Paradigm, listed by Binance, and it's being hyped as Solana 2.0, and it still cannot hold its price. People are now saying this is proof that the altcoin market is completely dead. Like this cycle is weird because we didn't see a full-on alt season. Even with multi-million, so more than $225 million raised, a giant airdrop, and Coinbase fast ever token sale backing it, Monad is still struggling to gain traction for some reason. So today we're breaking down what actually happened: the launch, the airdrop, the IEO, the FUD, and some accusation about Monad being the gold chain, just like Bearish chain. So if you guys didn't know, Monad is a new high-performance layer 1 blockchain designed to be fully EVM compatible. It targets like more than 10,000 TPS and very low gas fees, positioning itself as a faster parallel execution alternative to Ethereum. The project is built by Monad Labs, backed by major investors like Paradigm and Coinbase Venture, raising $225 million, with a total supply of 100 billion Monad tokens, so MON tokens, and 10%, roughly 10%, so 10% circulating supply at launch. Monad is being hyped as Solana 2.0, but like right now, it creates so much negativity and people are so unhappy with Monad, because what happened is that we have the airdrop last week. So the MON token airdrop went live alongside mainnet launch. What airdrop means is that, okay, it rewarded early testnet users, contributors, and community members with 3 billion MON tokens across like multi-thousands of wallets. So the key details, the key takeaway, why people were so mad is that, okay, despite they try to block those farmers, the big abuse of the system very much still happen, because like for a big project like that, and they have been hyping up for years, and everyone knows that they're going to do an airdrop, of course there's going to be farmers, and they try to abuse the system, and that's very much what happened. And for the farmers, they earned some farm a lot of the tokens, MON tokens, but most of the retails, they got small allocations. Like 40% got under $250 when they've spent like days and days, weeks and weeks to farm that airdrop. So that's why people are so frustrated with that airdrop. And usually, like we know, is an airdrop token. And post airdrop, this is the price action we saw. Yeah, I mean, this shouldn't come across as a surprise, right? But again, it has been hyped for years, and somehow people still have hope that out of all the tokens, out of all the altcoins, Monad is going to do great. And not just because of this, like the backing. Coinbase actually has Monad token as the first token sell ever on the platform. So people are so hyped. People think that if this is the first project that Coinbase chose to launch, maybe the floor price is protected. And for the ICO price, it launched at 2.5 cent. And then we are looking at just like last week, and then we already went below the launch price. That's why people are so disappointed. And turns out like people thought Coinbase would defend the floor price, but of course they didn't. Like they did not buy tokens to defend the price. Of course, like there is some myth out there. Like people seem to think since it's the first project on Coinbase, like Coinbase need to defend the price. Like there was never guarantee Monad will stay above 2.5 cent. But that is just a narrative people have been throwing around for Monad because we were hype and we were retails. So what Coinbase did is that there were early sellers get smaller allocations in future token sales, and there's like reduced chaotic volatility because it's Coinbase after all. But they don't guarantee they're gonna ape in and buy and defend the price. What we got is that the backlash from the community, a huge chunk of the anger comes from the distribution model. Like many dedicated testnet users, like people who spend months interacting with apps, receive tiny or even zero allocations. Meanwhile, KOLs like Discord mods and crypto natives, like so-called crypto natives, walks away with relatively noticeable bigger bags. So that's why people are saying like the airdrop, a social experiment gone wrong, is a disgrace, and so much negativity. Like people are saying that they got betrayed by Monad. And here, if we look at what Arthur Hayes has been saying, he was saying that Monad is just another bear chain. It's a ghost chain, and beyond the airdrop, the mainnet launch itself wasn't smooth after all. Like many dApps were not ready or barely functioning. Those like NFT meme coin launches struggle with some down like 50 to 90% almost instantly. And there's a high token supply creating this like dilution fears. And that's why maybe Monad, the tier one project of this cycle, maybe it would really turn out to be a bear chain, but like, I don't know. Right now, what I know for sure is that if we enter this Monad, like, of course, not financial advice, like what it looks like is that high risk, so early stage and high volatility. But if you participate in the airdrop farming actions, just make sure you check the if you're eligible for the airdrop, understand the vesting period, and do expect heavy dilution. Just treat it like an early stage L1. Nothing is guaranteed here, and especially in a market crash like this. And we have been talking about this for the first half an hour of the show. So if you didn't watch that, go back and watch the TA. And so far, I'm really bearish on altcoins. And one of the best decisions I made in this cycle, or okay, maybe just like in the past month, is shorting altcoins. And so far has been doing great for myself. All right, so thanks to TA. All right, that's pretty much all I want to cover in today's content. Just a last call to action. Make sure to give us a follow on Twitter. So my Twitter is gemgemcrypto_io. Make sure to follow RoxomTV as well, because we have regular updates coming out every half an hour. So here, that's me coming live. We not only talk about Bitcoin, but geopolitics news, global news, or macro news. So there's many valuable contents that you don't want to miss out. So make sure to give us a follow at RoxomTV. All right, so my show is from Monday to Friday, 3 a.m. Eastern Time. I'm extending my show from 1 hour to 1.5 hours. So thank you so much, guys, for watching. I'll see you guys in tomorrow's show.